2 years ago, most investors had already written off Rivian. The headlines were brutal. The company was burning billions of dollars. Production was slower than promised. The electric vehicle market was suddenly cooling off. And the stock? It collapsed more than 90% from its peak. For a while, Rivian looked like just another EV startup that Wall Street got carried away with, and then quietly abandoned. But here's the strange part. While many investors stopped paying attention, something inside the company started changing.
Costs started falling. Software revenue started rising. Production quietly stabilized. And now, suddenly, there's a date circled on the calendar, March 12th. On that day, Rivian plans to reveal key details about the vehicle that could change everything for the company, the new R2 platform. And for investors who understand what's actually happening beneath the surface, that date might explain why some analysts believe Rivian stock could be a buy right now, not because the company is perfect, but because the math of the story might be about to change. To understand why this matters, you have to start with a simple question. Why did Rivian struggle so much in the first place? Because the company made the same mistake many ambitious startups make. It started at the top. Rivian's first vehicles, the R1T pickup and the R1S SUV, were expensive, premium machines. Powerful, beautiful, technically impressive. But they started around $70,000, and that's a problem. Because the electric vehicle market, despite all the hype, is still extremely price-sensitive. Most people don't buy EVs because they want cutting-edge technology. They buy them when they become affordable, which is why the most important car in modern EV history isn't a luxury vehicle, it's the Tesla Model 3. That car changed the industry because it dropped the price of an electric vehicle into the range that millions of people could actually afford. And that's exactly what Rivian has been trying to build ever since, the R2. A smaller, more efficient, lower-cost SUV expected to start around $45,000. Not cheap, but dramatically cheaper than Rivian's current lineup. And that difference matters more than most people realize. Because when automakers launch a new platform, they're not just launching a car, they're launching an entirely different cost structure. Think of it like building a house. The first house is always expensive. The tools are new, the process is messy, mistakes are everywhere. But by the time you build the 10th house, the process becomes efficient. The same thing happens with cars. Rivian's early vehicles were incredibly complex. Multiple drive units, advanced suspension systems, premium materials. Amazing vehicles, but expensive to build, which is why for years the company was losing huge amounts of money on every car it sold. But something important changed in 2025. Rivian finally achieved its first full year of positive gross profit. That might sound like a small milestone. It isn't. Gross profit simply means this: the company is now selling its products for more than they cost to manufacture. It's the first sign that the underlying business model is starting to work. In fact, Rivian improved its annual gross profit by roughly $1.3 billion compared to the previous year. That's not a small adjustment. That's a structural shift. Costs per vehicle dropped by nearly $9,500. Average selling prices went up, and suddenly the math started looking a little less impossible. But the real turning point isn't the R1 vehicles, it's what comes next. Because the R2 is designed differently from the beginning. Simpler architecture, fewer parts. Lower manufacturing complexity. And most importantly, mass market pricing. If the R1 was Rivian's proof that it could build an incredible vehicle, the R2 is the test of whether it can become a real automaker. And March 12th is when investors will finally see how serious that effort is. The company plans to reveal more details about pricing, configurations, and launch plans for the R2 platform at that event. Which means Wall Street will suddenly be able to model something it hasn't been able to model before. Real demand, real margins, real production scaling. Because right now, Rivian's story still feels incomplete.
The company produced about 42,000 vehicles in 2025. That's impressive for a young automaker. But compared to the millions of vehicles sold by legacy companies, it's still tiny, and the market knows it, which is why Rivian's stock has remained volatile. Investors aren't sure whether the company will become the next major EV manufacturer or just another interesting experiment that never quite scales. The R2 could answer that question. But here's where the story gets more interesting, because Rivian isn't just a car company, and that's something the market may still be underestimating. Over the last year, one of the fastest growing parts of Rivian's business hasn't been vehicles at all.
It's software. In 2025, Rivian generated $576 million in gross profit from software and services. That's an enormous jump from just $7 million the year before. And the reason for that growth is a partnership that most investors barely talk about, a joint venture with Volkswagen. The two companies are collaborating on electric vehicle architecture and software platforms, which essentially means this: Rivian isn't just building cars anymore. It's building the operating system that other automakers might use to power their cars. And if that model works, the company's economics start looking very different.
Because software businesses have something that car manufacturing almost never has: high margins. Once the software exists, selling the next copy costs almost nothing. And suddenly, the company that looked like a capital-intensive manufacturing startup begins to resemble something closer to a technology platform. That shift is subtle, but extremely important. Then there's another layer to the story: autonomy. In December, Rivian held its first Autonomy and AI Day, and the company revealed something surprising. It's building its own self-driving chip, the Rivian Autonomy Processor, a custom chip designed specifically for autonomous vehicle systems. This might sound like a small technical detail, but it's actually a strategic decision.
Because the companies that control the computing platform inside vehicles control the future of transportation, and Rivian clearly wants to be one of those companies. The plan is for the next-generation autonomy system to appear in the R2 platform, eventually enabling advanced autonomous features, including hands-free and potentially eyes-off driving. If that technology works, Rivian could introduce subscription-based autonomy features, similar to what Tesla has been attempting with full self-driving. And again, this matters for one reason: margins. A car company that sells vehicles once every decade is a tough business. A car company that sells software subscriptions every month, that's something entirely different. Now let's zoom out for a moment, because Rivian isn't operating in a vacuum. The entire electric vehicle industry is going through a strange transition.
A few years ago, the narrative was simple. EV adoption would grow rapidly, every automaker would rush into the market, and companies like Rivian would ride a massive wave of demand. But reality turned out to be more complicated. EV growth slowed, interest rates rose, and many legacy automakers quietly started scaling back their electric ambitions, which creates a strange opportunity, because when competitors retreat, the companies that remain suddenly face less competition, and Rivian is still pushing forward. The company now expects vehicle deliveries to grow more than 50% in 2026, potentially reaching as many as 67,000 vehicles. That's not explosive growth, but it's meaningful, especially for a company still early in its production curve. And if the R2 succeeds, that growth could accelerate dramatically. Of course, none of this means the story is risk-free. Far from it.
Rivian is still losing billions of dollars each year. The company expects adjusted losses between $1.8 billion and $2.1 billion in 2026 as it scales production. Building cars is expensive. Building electric cars is even more expensive, and scaling manufacturing has destroyed more startups than almost any other challenge. Even companies that eventually succeeded, like Tesla, nearly went bankrupt during this stage. Which is why Rivian's balance sheet matters. At the end of 2025, the company still had roughly $6.6 billion in liquidity. That's not infinite money, but it's enough runway to continue building the business, at least for now. And in the EV industry, runway is everything, because the companies that survive long enough to reach scale are the ones that usually win. But perhaps the most interesting part of the Rivian story isn't the technology, or the vehicles, or even the finances. It's the timing. Because Rivian might be entering the most important phase of its entire existence.
The phase where startups either become real companies or quietly fade away. For Rivian, that transition depends on one simple question. Can it build a vehicle that millions of people actually want? Not a niche luxury truck, not a futuristic concept car, a normal car. Affordable, practical, reliable. That's the real test of the R2. And March 12th might be the first real glimpse of whether Rivian is ready for that challenge. If the vehicle delivers what investors hope, the company suddenly starts looking like a legitimate long-term competitor in the EV industry. But if it disappoints, then the market may start questioning whether Rivian can ever escape the niche it started in. And that's why some investors are paying such close attention to the stock right now. Because before major product reveals, stocks sometimes move quietly, before the news, before the headlines, before the broader market notices. And occasionally, that's when the opportunity exists. But there's one more twist to this story. Because even if Rivian executes perfectly, even if the R2 becomes a hit, even if production ramps smoothly, there's still one uncomfortable truth about the electric vehicle industry. Scale wins. And scale is brutal. Companies like Tesla already
produce millions of vehicles per year. Legacy automakers like Ford and General Motors have decades of manufacturing experience. The competition is enormous. Which means Rivian doesn't just need to build good vehicles, it needs to build them efficiently. At scale. For years. And that's something no startup can prove until it actually happens. So when investors ask whether Rivian stock is a buy before March 12th, they're really asking a deeper question. Not about one event, not about one vehicle, but about something much bigger. They're asking whether Rivian is about to become the next major electric vehicle company, or whether the EV revolution will once again remind us how difficult it is to build cars at scale. Because in the end, the fate of Rivian may come down to a single, uncomfortable equation. It's easy to design a great electric vehicle. It's much harder to build millions of them. And the market is about to find out which side of that equation Rivian really belongs on.